Hey guys, welcome to another video. Thanks for joining me in this one. And in this video, my goal is to share with you some of the things that has actually happened this past week, by the way, if you're watching this video. There are a lot of things that actually went down, and I want to share some of these things with you, especially if you are investing, you're interested in, of course, figuring out how to make more money or how to save more money. This video is for you. So let's start with the first thing. And oh, wait. Before I actually get into the video, my name is Stephen Ojo, and on this channel we talk about finance, saving, investing, and everything that has to do with pretty much working on our personal finances. So I hope that you stick around by subscribing to this channel. It's very important. It helps the channel to grow, and of course, it helps to keep me coming back to share some of this information that I gather over time and experience as well. Of course, my environment is always changing because of the nature of my job, so I want you to kind of bear with me if you see me in different places. But let's get to the video. So one of the first things I would like to share with you is the CPI report. I'm sure you guys have seen it. It came out on 14th of February, which was Valentine's Day. And one of the things that actually is interesting is that it came a little higher than expected. It still went down, but a little higher than expected. It was expected to be 6.2%, but it came out to be 6.4%. The last CPI report was 6.5. So it was barely, the fact that interest rates has been increased over time barely made a dent on this last report. We are looking forward to the next one that will come out in March 14th, which will show us what exactly happened for the month of February. We'll keep that in mind. Now, with that CPI report, of course, the stock market went into a yo-yo type of day. It went down, then finally came back up again, which is very, usual for those kind of reports. We made progress in the right direction. However, it just wasn't as high or as fast as we want the inflation to go down. One of the important things here is, what does the Fed do with this type of information? It shows that, well, there's still a long way to go. The goal is always to get inflation down to around 2%. And it being at 6.4 right now means that we still have, a few ways to go. And that also leads us to what the actions of the Feds are likely going to be. As we know, one of the tools that the Feds use in fighting inflation is interest rates. So the goal now of the Fed is, of course, to further increase rates. Currently, this rate sits around 4.5 to 4.75, and with the next meeting that comes up around March 21st, the next meeting that is coming up, it is expected that the Fed would most likely increase rates. To even add, I guess, salt to the injury, as they would say, the PPI report also came out this week. Now, the PPI report, which is the Producer Price Index, also showed that the prices of producers or suppliers still went higher than the previous, which meant that the cost of services and these goods that these producers are either selling or making would end up being passed on to the consumers, which also means that the cost of this of goods will still be higher. And that is not a good feeling when it comes to the goal of reducing, cost of goods in general, or at least bringing interest rates down. If you look at the previous inflation report, we've seen that in 2022, we started the year with 7.5. We ended at 6.5. Of course, it went higher and then eventually started coming down. And we've been on the downtrend since the peak of 9.1. All right. So now it's gone down to 8.5, 8.3, and now we're currently sitting at 6.4%. The next report, next CPI report, like I said, is going to be in March. That's when the next one comes out. So we'll see what that report looks like, and hopefully it's trending in the right direction. But with this bad news, all right, which is not good for the stock market, comes a little bit of good news, and that leads us to our savings. All right, savings. When you are saving, or if you have cash that you are preserving, then you want to consider that you're making the most out of your bank, or at least the bank is giving you most that you can make. So if you think about it, most of these brick and mortar banks, which I'm not going to mention, most of them are usually offering 0.01% rate. Maybe they've increased to maybe 0.05 now. All right. But from online banks like Ally Bank, Marcus by Goldman Sachs, Barclays, and so many other online banks as such, they would offer you rates as high as 3.75. In fact, Marcus by Goldman Sachs is one of them. And one of the things you want to do is to make sure that your money is put in this type of savings account while while interest rates are increasing, because the flexibility of this type of banks of increasing rates and also the desire to actually offer you higher rates is way more than what you'd get from a regular brick and mortar bank. So that's why you want to start considering putting your money into this online savings account, so that your money that is being eaten away by inflation, as we know, at least you can recoup half of it or more than half of it by putting it with a bank that offers high interest rates. The other thing, if you want to take it a step further, is to consider certificate of deposit. Certificate of deposit, I've always talked about this. They can always come in handy in times like this, especially if you find ones that will give you high rates within maybe the time period of 6 months. That is always perfect, that you can pack this money, put it in a place that will give you maybe close to 5% for maybe 6 months. The one I found that gives up to almost a year is about 4.75. And I'm sure if you shop around more, you find some that even gives maybe within 6 months that gives up to maybe 4.75 or more. And the goal here is to pack your money in there, let it sit for that 6 months, and after 6 months you can roll it all over again. The reason why you want to do that is you don't want to lock your money into, for example, a 3.75% CD and put it in for a year, because currently interest rates is around 4.75, which still has room to go because of the fact that inflation is still high. So our goal here is to put our money in a place where, as they adjust the interest rates, we are able to capture those higher rates by turning over our money in maybe a CD and getting a new higher value for our money. That is important. The other thing I want to talk on is, if we are investing in the stock market, we need to understand that the market is going to be very volatile for the foreseeable future, and that is because of the fact that there's a lot of fear, there's a lot of uncertainty that is going on in the market. So that is something that we need to keep in mind, and we need to expect it, which also leads me to the point of your risk management. You have to understand that this market will test your tolerances for, the red days when it goes down. You need to be able to withstand and not worry and not fear and not sell off during those times. And in fact, those are the times for you to buy those good companies like Apple, like Alphabet, like Google, like Amazon. Those companies would always show resilience because of just the nature of their business. They're well diversified. These are not just companies that are limited to just the US economy. All right, so you need to consider those in your portfolio if you don't currently hold some of those. And of course, you don't have to do single stocks. You can always do index funds. All right, you can always do index funds, and you can always do the money market accounts. And this goes in for, like, if you don't want to do savings account, if you don't want to do, if you're not heavily invested in the market right now, you can always do the money market accounts. This will offer you a very better return in terms of interest rates, in terms of the rates that they give, than you get from a CD sometimes, and also sometimes from a savings account. So like I mentioned, the next CPI report comes out March 14th. So keep that in mind, at 8:30 a.m. The next FOMC meeting, which is the Fed's meeting, is March 21st. And this is when we're expecting to see another rate hike. The general consensus right now is a rate hike of at least 50 basis points, which is 0.5% higher, which will put us into the rate of around 5%. Currently, like I said, it sits around 4.75. But by the time they had another 5 or 50 basis points to that, we find ourselves with interest rates of about 5%. And that is something that, that's considered really high. And that would affect, all our borrowing power, our credit cards, car payments, things of that nature. Those things will be affected. If you're trying to buy a new car now, this may sound like a negative, bad news, pretty much. And that's why you want to make sure that, you tighten up your finances, and hopefully, we get over this period. The stock market, like I said, will continue to be volatile. So keep in mind, your goal here is to keep a level head, find the companies that you believe in long term, buy them and dollar cost average. Buy those companies when they are down and hold them. If you found value in this video, please give it a thumbs up. Don't forget to leave your thoughts in the comment section below. And of course, subscribe to the channel. I appreciate it so much, and I look forward to seeing you in my next video. See you.